Welcome back, family, to episode 3 of our Institutional Order Flow Masterclass on Liquidity Hunter. In the last 2 episodes, we exposed how market maker algorithms hunt liquidity above, resistance, and below support. Before we jump into episode 3 of our Institutional Order Flow Masterclass, take 2 seconds right now to hit that like button and subscribe to the channel. Done it? Perfect. Now, let's get straight into episode 3. Today, we are unlocking the holy grail of algorithmic framework: internal versus external range liquidity. If you don't understand this concept, you are spinning your wheels, taking random trades, and wondering why you keep getting stopped out. The market always moves from internal to external, and external to internal liquidity. Let's look at this 4-hour chart on gold in image 1. The first thing an institutional trader does is define the current trading range. Notice these 2 horizontal neon white dashed lines. The absolute top of our swing structure is labeled external range high, which holds massive buy-side liquidity. The absolute bottom of our swing structure is labeled external range low, which holds massive sell-side liquidity. This macro frame represents our external range, everything. Sitting outside of these 2 boundaries is external liquidity. Now, look at image 2. What happens inside the middle of this massive trading range? As price expands aggressively from the low to the high, it leaves behind structural footprints. This beautiful, translucent neon yellow rectangular box represents our internal range liquidity, specifically a fair value gap or an order block. Retail traders look at the middle of the chart and see noise, but the algorithm looks at the middle of the chart and sees inefficiency that must be filled. The smart money uses these internal gaps as refueling stations. Before the market makers can take price to a major macro destination, they must return to balance by mitigating these internal fair value gaps. Remember this rule: when price is inside the range, its target is the external liquidity. Once external liquidity is swept, its next target is the internal liquidity. Let's watch the algorithm execute this framework perfectly in image 3. Look at how price expands sharply to the upside, targeting the external range high. A single, aggressive candlestick wick pierces cleanly through our white dashed line, completely validating the red arrow labeled external liquidity swept. This is a massive stop run. The algorithm has successfully harvested all the buy stops resting above the market. Retail traders are buying the breakout here, thinking the trend is continuation. But as professional hunters, we know the truth. The external liquidity has been cleared, which means the current market cycle for the upside is officially complete. The market makers have filled their pockets, and the laws of algorithmic gravity dictate that price must now reverse. Once external liquidity is swept, what is the next draw on liquidity? Look at image 4. The price completely reverses with heavy institutional displacement, turning heavily bearish. This massive neon blue gradient arrow illustrates the exact mechanical path of the market: delivery to internal liquidity. Price is being drawn like a magnet straight toward our internal yellow, fair value gap box. The algorithm is systematically driving price back down to rebalance the inefficiency it left behind earlier. This is where retail traders get completely crushed. They start buying the dips, thinking the market is just retracing softly, but they are fighting an institutional freight train, heading straight for the internal range pool. Finally, look at the absolute beauty of engineering in image 5. The market candles descend perfectly right into our internal yellow FVG box and instantly begin to react. The exact moment price mitigates this internal liquidity, we trigger our confirmed internal range entry right inside this neon green targeting crosshair. This is how you trade with 90% precision. You wait for the external sweep. You ride the delivery into the internal range liquidity, and you execute exactly where the banks refuel. Your risk is fully defined, and your profit target is now locked back onto the opposing external range low. This is the endless loop of the financial markets. Stop guessing, stop trading the middle of nowhere, stop being the liquidity, and start hunting it. If you want to master order blocks in episode 4, make sure you are subscribed. See you in the next session.